perfect guest to talk about the interplay between the public market and the private market because of your time at Goldman Sachs, because of your time on a credit desk. What's happening in the private market as we continue to see the nervousness, especially in tech stocks and IPOs in the public markets?
Yeah, thanks, Sarah. It's very similar to what we're seeing in the public markets as well. I would say the IPO window is effectively closed. It's closed for the great companies, the category leaders, because they're well capitalized enough and have enough leverage to wait out the volatility in the current markets, and so choose to chart their own course. And it's effectively shut for all the second and third tier businesses for obvious reasons that you mentioned earlier. And so this is much more of a time of deployment for the venture capital industry. I think the period for harvesting was the last 12 to 24 months. These things flow in cycles, and so we're focused here on acquiring businesses, acquiring shares in companies, where we feel like there's been an overreaction. But certainly, we expect the IPO window to be shut for the foreseeable future, and we don't expect that to change until there's some more stability, in the rates markets with respect to Fed expectations.
So like what? Where are the opportunities? Where are the overreactions?
One of the interesting things about venture capital is companies raise money so infrequently that the valuations are punctuated by infrequent primary rounds that happen every 12 to 24 months. We tend to focus a lot of time on the secondary markets, so there could be overreactions in any space or any sector because the sellers that you're looking for are either early employees or early investors. Companies that are well capitalized are not going to raise money into this downturn. High quality CFOs, high quality C-suite teams understood the era of easy money that they were in over the past 24 months. Most of them are very well capitalized, and now they're in a race where they're hoping that their growth outpaces the inflation, and the volatility in the markets. Companies that need to come to market are going to have to take serious haircuts to their last rounds, and we've already seen some of that happening over the last 6 to 9 months.
So what are we talking about? Serious haircuts? Is it match up with NASDAQ's down 30% this year?
Yeah, absolutely. High to low, I would say the moves are actually more commensurate with things like the Renaissance IPO index and even the SPAC market. Some of the higher growth, unprofitable names on the private side in the secondary market are down anywhere from 50 to 90%. Those are typically concentrated in businesses where the path to profitability is less clear, where the unit economics haven't been proven out. And essentially, investors are less willing now to value future cash flows at the same level they're willing to value present cash flows. The flip side is that, you're thinking of some of the category leaders, SpaceX, names in the defense sector like Anduril, ESG levered names and solar technology, et cetera. Businesses where previously there were very well-funded second and third tier players coming in with easy money from essentially very large mega cap funds, creating pricing wars, forcing them to price down. We're seeing a lot less of that now. So we actually feel like the second and third order effects of this will be a consolidation of capital around some of the incumbents, which will actually probably benefit some of these market leaders in the next 12 to 24 months. But currently, I think that the correlation is actually relatively 1-for-1 on the private side.